Crisis at Wells Fargo? I'm your host, Steve Metre, and thanks for joining me today. Big problems at the big bank signal an ominous warning for the economy. So over to CNBC, where we picked today's story up, as Wells Fargo mortgage staff brace for layoffs as U.S. loan volume collapses. Mortgage volume at Wells Fargo slowed further in recent weeks, leaving some workers idle, sparking concerns the lender will need to cut more employees as the U.S. housing slump deepens. And this is a topic we've talked about on this show before, that when you see particularly a rapid rise in interest rates, demand for lending goes down. And the U.S. economy is highly interest rate sensitive. You think the housing market alone is 20% of the U.S. economy, and a lot of those jobs are directly tied to lending. So when lending demand goes down, jobs are going away. The bank had about 18,000 loans in its retail origination pipeline in the early weeks of the fourth quarter, according to internal figures. That is down from as much as 90% from a year earlier, when the COVID pandemic-fueled housing boom was in full swing. And you can think about that. A 90% decline in business doesn't mean you need 90% fewer employees, but you can sure get rid of a lot of them and still have enough to service what's there. And of course, as we know, with rates holding high, the Fed keeping them up there, it means demand for loans is going to go down even more, and people are going to be on the unemployment line going into the holidays, which is a terrible thing to see. The situation has pressured the home loan industry, particularly firms like Rocket Mortgage that thrived on loan refinancing, is expected to lead consolidation among newer non-bank players that rushed to serve customers after most U.S. banks receded from the market. When we did a show about non-bank lenders, we talked about how they were going to fail. Now they're going to consolidate and then fail because their entire business model is predicated on one thing, and that's doing a loan, packaging it with other loans, and selling it and making money on it. No loans, no packaging, no profits, no business. We expect it to remain challenging in the near term, the CFO of Wells had to say. It's possible that we will have further decline in mortgage banking revenue in Q4 when originations are seasonally slower, telling investors, look, if you're betting on our stock price going up because we're going to do a lot of loans, don't bet too big because mortgage business is on its way down. The ranks of mortgage loan officers who mainly earn commissions from closing deals is expected to drop to under 2,000 from more than 4,000 at the start of the year, according to People. Many salespeople haven't closed a single loan in recent weeks. Now, you think about this, and I used to work in the mortgage industry, so you think about it, it's a feast or famine business. And those of you that are in it or have a friend or family member, you know this. And what happens is, as the demand for loans shrinks, and there's only so many of them being done, there's only a need for so many people in the mortgage industry to feast off of what's left to take care of their family. And so what happens is you have all the marginal players, all the marginal people who don't have savings, they get sent out and away to the unemployment line or to other lines of work. And this is why you'll hear people in the mortgage business in particular have big cash reserves, because they know if they can just ride through the rough times, they'll be there when business comes back. So what we're seeing here at the time of, again, we're going into the holiday season. This is a key point where we have a high level of retail and wholesale inventories. What do you need? You need demand from people to buy. But if you have people that aren't making a commission, aren't getting business, and not having any prospect of it, and perhaps even worse, facing the unemployment line, you can see demand in the holiday season is likely to go down. The changes we've recently made are a result of the broadening rate environment and consistent with the response of other lenders in the industry, according to Wells. We regularly review and adjust our staffing level to align with market conditions and the needs of our businesses, and suggesting that staffing levels are going down even more in the future. Now, I want to dig deeper into what the game these banks are playing here, because I want you to understand just how good they are at executing this. And something I want to look at first is these 3-month to 10-year yield curve inversion. Now, let's go to the U.S. Treasury here, because I want you to really understand what's going on here. And you can go and look at this every day if you want. Here you can know, as of yesterday, 3-month T-bill, 4.22%. Look at the 10-year, 4.1, 30-year, 4.15. So this is an inversion when long rates are lower than short rates. And let's look at this on a chart, because the banks are so good at this, you're not going to believe it. And on this chart, we have that 10-year, 3-month yield curve in red with the baseline here, this crudely drawn yellow line. In blue, we have the net percentage of domestic banks tightening standards or lending standards, and the baseline for that is in blue or in black. So every point you see this blue line above the black line, that means banks are tightening lending standards at a faster pace if it's rising. If it's coming down, tightening at a slower pace. So what I want you to see is you start to get these curve inversions as banks tighten lending standards, and you can see that happen very consistently here. And then what happens is the yield curve starts to rise, rates start to fall, and I want to point out that banks further tighten lending standards. So what's going on here is you say, why have banks been in a rush to get all these loans at higher rates, knowing that rates are going to go down? Well, they sell the customers on the same story is, don't worry, you can always refi if rates go down. Of course, what they don't tell the customers is we're going to tighten lending standards, you're going to come back, and suddenly, magically, you're not going to qualify. And that's fine. You can go to our competitor. Guess what? They're not going to give you a lower rate either. You're going to get trapped here, and we already know it. And that's what I want you to see. Banks are well executing this plan to tighten lending standards now and trap people in high interest rate loans at a time that we should start to see interest rates fall. So now you see the net percentage of domestic banks tightening standards here again in blue against 30-year treasury yields, and we can note that it's not unusual to see periods where tightening standards start to tighten and rates do actually rise. It's not unusual to see that. It doesn't always happen, but it's not completely unusual. But what then happens is rates start to fall and lending standards again stay tight, and you can see they fall, and people can't qualify for them. And so again, we know that what the banks are up to here is they're likely to start driving rates down, and that's simple because when they get a deposit, they either have to lend against it to generate revenue, obviously to pay the depositor an interest rate, or they have to go buy treasury securities. In this case, all they have to do now is tighten lending standards, go buy bonds, drive rates down, and what are they going to do with those bonds later? Sell them? You got it. At a profit. And it's not just Wells that's laying off. Look at this. It's spreading. OpenDoor lays off 18% of its workers in the wave of housing cutbacks. The layoffs will reduce OpenDoor's headcount by about 18%. The cuts come after an abrupt shift in prices forced the company to sell homes for less than it paid for them. So on another topic here, so not only do we see banks playing games with the interest rate market and profiting on it, what we have is people believing that their housing market is at a permanently high plateau. And I want you to see here is there's a lot of speculation in the housing market, and all it takes is someone who's upside down to start being forced to unload them, and OpenDoor potentially being one of those, to start driving prices down, and then those who need to sell are forced to compete and lower prices even further, and then you get a snowball effect. OpenDoor, which practices a data-driven spin on home flipping called iBuying, should be called iFailing, was among companies caught by a sudden turn in the housing market as soaring borrowing costs pushed some buyers to the sideline. The iBuying model relies on permanently rising home prices, acquiring homes and making some repairs and then selling the properties, often in a short period of time, which clearly isn't working. The reality is we're navigating one of the most challenging real estate markets in 40 years and need to adjust our business. To manage through the turbulence of the market, we've worked quickly over the last 2 quarters to reduce our operating expenses. So what you're hearing from OpenDoor is saying, look, we actually are hoping prices come back up. And so we're going to trim our staff and our expenses down and hope to get out of this mess that we created, because our program was pretty much predicated on prices only going up. Prices keep going down. Watch companies like OpenDoor go insolvent when they can't unload their property fast enough. And it's not just the banks here. We're also seeing now into the investment banks, potential layoffs coming there. As Morgan Stanley starts to lay off in coming weeks as deal making slows, again, everything tied to interest rates and business around interest rates, with prospects of arranging and financing deals drying up, as obviously people don't want to borrow at higher rates. Some investment banks are firming up plans to cut jobs. And with the Fed, does that mean we'll continue to see higher rates? Well, I think what this means is the Fed is much closer to a pivot or a pause than most people think. Even what the Fed chair himself says, I think he's got this one wrong. As Fed rate hikes go even further than expected, as Powell commits to stomp out inflation, which is, as we'll show soon, headed lower. Powell and his comments said the Fed's window for a soft landing for the economy is narrowing, but talked tough on rates, indicating a likely recession in the future. We still have some ways to go, he said, and incoming data at our last meeting suggested the ultimate level of interest rates will be higher than previously expected. But when asked how high they were, he had no answer because he doesn't want to admit that they don't actually know how far they can take this, because that's how close they are to a pause. What Powell is telling you, even though the pace may slow for good reasons, for risk management reasons, or due to political pressure, we should be slowing the pace. But what he was also saying was the bulk of what they saw, in particular in labor markets and inflation, would lead them to believe the terminal rate was probably higher than they thought in September. I'll agree that that's not as true as it sounds, but it may be higher, but not that much. And I want to show you these two charts, because what we have here first is labor productivity, or output per hour. And that's how much work you get out of an employee in an hour. Now, I want to frame this because it's really important. When there's a labor shortage, what do businesses do? They hire everybody, anybody. They just need bodies. That's the problem. We just put bodies into the problem. And what happens over time is you learn how to do the job, and you get better at it, and you get faster at it, and you get more efficient. And so what would happen over time is you would expect to see the output of an employee increase. From an inflation standpoint, what is it telling us? It tells us inflation's peaked. That also tells us that Powell's terminal rate is probably here now, not higher. So let's take a look at this chart here, and we have the consumer price index in red. We have output per hour on the labor productivity in blue. And notably, you see peaks of inflation happen when productivity is at a bottom. And that's notable because what are we seeing here? You see after the great financial crisis, notably inflation crashed down, labor productivity was way up here. And that's exactly what you want to see, very productive employees at the bottom of an inflation cycle. But look, now you're starting to see on a year-over-year rate of change, productivity start to come off these lows, telling us that the likely chance that we are seeing a peak in inflation is here. The other evidence of this is in unit labor costs, or what employers pay for employees. So think about this. If you're hiring employees because you need labor, but the ones you have are starting to get more efficient in doing the work that you need them to do, guess what you don't have to do? You don't have to hire a bunch more people, and your unit labor costs start to go down because you can get rid of the underperforming employees because the higher performing ones are taking over their jobs. And look at this, what this means for inflation. And you can see a beautiful relationship here as unit labor costs go down. Notably, that tells us inflation is going to come down. It's likely a peak here as Powell is on the wrong side of the trade. And some other evidence of the ominous news that Wells Fargo is telling us about the economy. We look at the manufacturing purchasing managers index, came out at 50.2 here for the US. And what does that mean? It means unchanged for the month before. But look at this headline here: new orders contracting, backlogs contracting. Think of this from an inflation, a demand perspective, an economic perspective. Supplier deliveries, they're faster. Suppliers are getting their products or their materials to the factories faster. Raw material inventories growing, prices decreasing, exports contracting. Again, these are all signs of what things are not inflationary, telling us the peak might be here. But let's dig a little bit deeper in the report. What do we know? That new orders are contracting. And what happens when new orders go down? Unemployment will soon follow. So we know employment was unchanged, but likely to decelerate in the months to come. Customer inventories, this shocks me, remain low despite what we're hearing from shippers like Metre that we have warehouses full. But look at this, prices coming down too. And again, all signs that Powell's got this wrong. The economy slowing, and what we're seeing in Wells Fargo, OpenDoor, potentially Morgan Stanley, and all these other banks are less demand, less employees equals less demand and even fewer employees. The cycle is here. Inflation peak is likely in, and Powell's going to be forced to pivot even though he doesn't know it. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.